I think it's important maybe to even sort of step back and talk about private credit as to just explain it, right, for our audience. That we're using the term quite easily here. But private credit as a whole, and sometimes it's also referred to as private debt, very similar. It's, as we've been talking about, it's essentially non-bank lending or an alternative source of lending that generally refers to like a larger class, if you will, of higher yielding, illiquid investment opportunities or loans that are essentially privately negotiated. And they're also directly originated or typically originated with the borrower. So between a borrower and a lender or a group of lenders. And these transactions, once completed, are not traded in the public market. So within private credit, that broader asset class, I'd say there's many different subsegments inside of private credit that don't necessarily fit neatly within simple categories of of private credit. So you've got a very diverse range of risk return profiles, even within private credit. Got direct lending, that's the largest subsegment, which is most of where my comments are coming from. You've got distressed debt, mezzanine finance, special situations, venture debt, equipment, financing, asset-based lending. These are all within private credit. So when we talk about numbers of private credit and how big it is enormous. And when you talk about how many, new managers are coming into this asset class, it may sound and feel crowded because it's just another credit manager coming in every day, maybe right. 5 a day that you're hearing from. But there are so many different categories within private credit. It is now on the onus is on the investor or the advisor to take a better look at what strategy are you pursuing in private credit? What's your experience in that strategy? Or did you just come upon it because you thought it was, a way to pick up yield? Because certainly in today's environment, private credit is seeing incredible yield when you compare it to fixed income, when you compare it to high yield, with far less loss rates, far lower default rates. So it's a really compelling opportunity in private credit overall.
So thank you for that. That's where I really wanted to go, is about this whole ecosystem, right? Where did all this debt, borrowers coming from? Where is all this money coming from? How did we matchmaking? So is it fair to say that private credit is really non-bank lending? That's basic what it is. And we're lending, we're just not a bank. that allows us more flexibility to be more personalized to the borrower, more sensitive to their needs, and perhaps looking at a longer duration in terms of how we can help them to achieve their business objective through borrowing. I think I'm sort of reflecting what you said.
Yeah.
Right.
Yeah.
And it's also fair that not all banks are created equal, and thus not all private debt managers are created equal. And I don't mean better or worse, but they may specialize in different segment of the market, from very high credit to very low credit, or for different purposes. And so there's segmentation within this sort of asset class, if you want to call that. That further, I want to say complicated, but further you need to understand, I guess, who you're lending to and what is the objective of the lender in private credit. Is that a fair way of looking at it?
Absolutely. I'd say even if you took the largest subsegment of private credit, which is direct lending, that's where you're typically seeing senior secured, directly originated corporate loans, hence the term direct lending. That space in and of itself is the largest subsegment, but it's also segmented out itself into the type of strategy or the type of borrower that a non-bank lender is pursuing. You have a very vast middle market that we talked about earlier. Just so many companies considered middle market in size. Over 200,000 private businesses, which is enormous. But even within that span, you would typically segment the market by size of how big that company is. There's a lower middle market, kind of, in the single digit of cash flow or EBITDA, typically, the term in the industry. Then there's a core or more traditional segment of the middle market that could be more from like 10 to 100 million of EBITDA, and then an upper middle market with anything 100, 150 and higher. We've seen these segments actually shift around just a little bit as you think about private credit platforms growing and scaling and able to now service the needs of much larger borrowers that would have otherwise gone to the public syndicated market. So they're staying and choosing direct lending partners to execute their financing needs. So I do think that upper end of the middle market continues to grow and then thus shifts the core traditional middle market upward a little bit as to what each of these lenders can now service. So there are very many different ways, different strategies, even within just the subsegment of direct lending itself, where you can think about how does this manager's typical borrower look and what are the typical features of that borrower's needs that the lender meets? What customization, what flexibility, what covenants or lack thereof does a lender provide because it meets a different size borrower every time? And are there common features into the core middle market and common features in the lower middle market and common features in the upper middle market that lenders are providing? Or are they stepping away from that? Are they doing something different? So I do think it's helpful to know what is the market and are lenders doing market-like terms or are they doing something different?